Right, welcome. We got this recording happening right now, and my guest for today is Rob Campbell from Premier Mortgage Center in the great city of Guelph, Ontario. Um, so the format of this interview or call is to ask some questions because there's lots of information out there on mortgages, and I thought why not get a professional mortgage broker who does this for a living, full time? This is what he does day in, day out for many, many years, and ask him some questions that could be valuable to the audience here. So, Rob, why don't you give us the Coles Note 30-second introduction of who you are, what you do, how long you've done it, all that good stuff.
Awesome. Thanks, Nawar. Thanks so much for allowing me to do this with you. I really appreciate it. You hit it on the head of the nail. Rob Campbell with Premier Mortgage Center. I'm up in Guelph, Ontario, the booming metropolis of Guelph, Ontario. Brokering for 13 years now, and Premier Mortgage Center is a brokerage that's in Ontario and Atlantic Canada, so all of the provinces in Atlantic Canada, and I'm just one of many great brokers at Premier.
Great, thanks, Rob. So we'll dive right in. I got 5 questions that I've prepared here, and the first question is if you would please explain the down payment requirement for 2 type of properties. One, as a homeowner, I want to buy a house or a condo or a townhome and move in. And the second part would be if I want to buy a rental property for the purpose of putting tenants in. I have no intention of living there. It's just strictly as an investment.
Okay, great. So as probably a lot of your viewers might already know, different down payment requirements for owner occupied versus an investment property. So if you're going to occupy the property as your primary residence, you can still buy in Canada. There's a caveat here, which I'm sure we'll get into, but you can still buy in Canada with less than 20% down as a. It doesn't even have to be a first time buyer. You could be selling. Nawar, if you sell my home today and I'm looking to upsize to a bigger home, I can do as little as 5% down up to the point of $1 million purchase price. So, your clientele is predominantly in the GTA area. You might be able to find a cardboard box less than $1 million in the GTA, but in other parts of the province, like in Guelph, you can still find a detached family home for less than $1 million. So if you are buying with a property to occupy and it's under $1 million, you can do as little as 5% down. There's a bit of a tiered system there as far as the down payment, but the Coles Note says you can do less than 20% down. If you're buying an owner occupied property that's over $1 million, you need at least 20% down. And that is a good segue into an investment property. So Nawar, if you're not selling my home, but you're helping me buy an investment property as a rental, a standalone rental, or maybe a multi-unit, you're going to need 20% down regardless of the purchase price. And that is the rules here in Canada for an investment property.
Can you sorry to interrupt you, but on the tier, can you elaborate more on that tier system? If you're buying, let's say your first time buyer, you're buying a condo downtown, it's $650,000.
Yep, let's do
first time home buyer.
Sure.
What's the down payment requirement on that $650,000 purchase?
Good question. You're going to test my math early in the morning. So it is 5% on the first $500,000 purchase price. Okay, so if you're buying at 650, you can do 5% of the first 500,000, so that's $25,000, and then it's 10% on every dollar above the 500 up to the $1 million mark. So $650,000 condo purchase is going to be 25,000 on the first 500, and then 10% on the next tier above that, which would be the 150. So that's 15,000 plus the 25. So you're going to be in for $40,000 minimum down payment. And then there's obviously insurance, CMHC insurance on top of that, which would get factored into the loan.
Okay, that's great. Appreciate it. I think that covers it all. And again, you've mentioned when it comes to investment properties, you have to have 20% regardless of the purchase price, whether it's $500,000 condo or 1.5 million duplex. You got to put 20 minimum.
That's correct. You might be able to get away with slightly less, but then we're going up to commercial financing where it's a multi-unit. Like if you're buying a 6 or 8 or 11 plat. then there's a
That's
little
a
bit of,
different ball game.
that's
Yeah,
a whole
yeah,
different ball of wax. We're not going to get into it.
yeah.
Basically 20% down. Yeah.
Okay, great. The next question that I have for you is, can you explain, please, how buyers qualify for a mortgage? There's this qualification rate. There's obviously the interest rate they get from the lenders they deal with. So if you would explain, please, how that works with respect to qualification.
Yeah, and this is a great question because this can be quite confusing for some. So if you are buying that owner occupied property um, with less than 20% down, you're gonna have to max out at a 25-year amortization. And government policy says that you've got to qualify at contract plus two. So if you're buying with less than 20% down, it's going to be the contract rate of your mortgage plus 2% or 5.2%, which is the MQR, the qualifying rate that the government has set. Still today, it's your contract rate plus two. So if your bank or your broker's got you a mortgage
Whichever
approved,
one's greater, right? Is that what
that's
it is?
correct. Whichever one's greater. Yeah. So that's why I just default to it's contract plus two right now, because a AAA mortgage rate right now for a CMHC insured mortgage is, let's just going to say 4.5%. Let's just say that that's the best rate that's out there, right? But you're going to have to qualify that mortgage on 6.5% because that's 2% over the contract rate. When you get down
Sorry to interrupt.
into,
I just want to say that we're recording this on early May of 2023. So in case someone looks at this video
yeah, don't be looking at
a
this in
couple of years down the line.
November. That's right, and try to sue us. This is
Yeah. It's
full financial
it's May
disclosure.
2023.
23. That's right. And something to mention here, Nawar, is it's a good thing you bring up is that these guidelines, OSFI and the Bank of Canada, they can change these rules at any time. So if you're under contract right now, you're going to be fine because you're going to fulfill that. You're going to be grandfathered in those rules. But so that will allow you to qualify on the contract rate alone. But the caveat there is that that rate's going to be padded up a little bit anyway. So, at best, you're going to be looking at a 6.5% qualifying rate. Regardless, you might be able to extend some amortization there up to 30 to make qualifying a little easier. But the general rule is contract rate plus 2%.
And that applicable for someone who's putting less than 20% and someone who's putting 25%? Is that same?
It's right across the board. Yeah, it is absolutely right across the board. It's the same for high ratio as it is for a conventional. It's the same for a rental property. It is contract plus two.
So at the time of recording in May 2023, it's contract plus two, whether it's less than 20% or over 20% down payment.
That's correct.
Okay, that's good. This feeds into the next question is, there's talk of this insured versus insurable. If you could explain the difference, because obviously as a homeowner or home buyer or real estate investor, when you're buying, because you're putting less, or I should say greater than 20%, this word sometimes comes insurable, which is, what is that? So
What
if
the
you could
heck is
explain the
that?
difference between these two, that'd be great.
Yeah, absolutely. So we'll start with insured. So an insured mortgage is what we had just talked about, less than 20% down, 25-year amortization max, and property value of a $1 million purchase price max as of beginning of May 2023. There is some talk that maybe the government will lift up that maximum purchase price for the insured mortgage qualification purposes, because again, you can't find much in the GTA for under $1 million for a single family dwelling. Now, insurable. So an insurable mortgage means that it is still a purchase file. We'll stick to purchases because you're a realtor, Nawar, so we're just going to stick to purchases. It is still a property that's under $1 million, but you are putting over 20% down, which means you don't have to pay the CMHC premium in with the mortgage, but the lender will be able to securitize that loan with the insurer if it meets all of their guidelines and then give you a little more aggressive pricing on the rate. It still has to fall within the $1 million max, 25-year amortization max. You can't go up to 30 as you could with an uninsurable mortgage. And And then there's some beacon score requirements, credit and employment and all that kind of stuff. So there's some criteria that it has to fall in within to make it an insurable mortgage, but you just don't have to pay the premium.
Okay. So
Clear as mud.
it sounds like there's three different pricing strategies from lenders across the board, which is insured, insurable, and uninsurable. Is
That's
that right?
correct. That's correct. And the uninsurable, to talk on that, is you can go up to a 30-year amortization with a conventional bank or broker lender. If you want to go into the alternative space, maybe your credit's a little bruised, maybe you're self-employed and you can't quite qualify with taxable income as paperwork, you might be able to get a 35-year amortization with some lenders. So that would
That
be an
still exists?
it does still exist. There's
Really?
a couple, less than a handful of lenders that will do 35-year amortizations. I want to caution the audience, it can be a very good uh, pause in between a transition for you to be able to get your family into a property that is going to check off all those boxes. However, you got to be aware of what's your exit strategy. You don't want to be stuck in this
Yeah,
35-year forever, right? Because you're going to be paying more interest
sure.
over the lifetime of the
Yeah,
mortgage.
makes sense. Okay. Um, all these are great segues. So the next question is, what features should homeowners look for in a mortgage? Obviously, interest rates is an attractive, I should say, a main focus of many homeowners is what's the lowest rate. But we touched on this insured, insurable, and uninsured, and all that type of stuff. But I'm sure there are other built-in features that maybe not as discussed as much or brought up to the surface when discussing mortgages with home buyers. So if it's something you can, explain and expand on, that'd be great for the audience.
Yeah. I think the most important thing for all of us to do when we're considering a move is considering the overall plan, right? So what's that saying? Fail to plan, plan to fail, right? It's so hard to sit down as a couple or a family on that next move to the next property and to say, where are we going to be in 2 years? Do we plan to be here for 5 years? Do we plan to be here for 10 years? Is this just if we're speaking to the condo, are we just buying this condo for the 2 year, 3 year window, and then we're going to get out into something else, right? The reason I mention that is because you want to be mindful of the product you're getting into. And we've been taught so many years, and brokers have been kind of the culprit of doing this to the public, shop for the lowest rate, get the lowest rate. And although rate is very important to help you with your family's cash flow, taking some time to really choose the right product that you might be able to utilize going forward after this property is something that's also equally important. We talked about credit unions. Credit
Mhm.
unions traditionally are provincially regulated, and they only lend within a certain bandwidth from their credit union locations, their branches. So what did we see over the last 3 years during the COVID pandemic? We saw people leave the GTA, leave Ontario, move to Alberta, move to the East Coast, move to BC. If although that wasn't something that was planned or kind of on anybody's radar, hey, what happens if you have a 1.89% mortgage rate with a credit union and you want to sell your condo in Toronto and move to Halifax? You can't take it with you because you're not with a national lender, right? You're not with a lender that's going to
Yeah.
be able to port that mortgage for you. So that's one thing to keep in mind, right? Where are you going to be? Um, the second is, there's some no frills products out in the world, and they come with a really low rate, but they come with some handcuffs. Some of those have clauses that you can't break the mortgage unless you sell the property. Not a big deal if you're going to sell the property, but some of those might come with big penalties. Some of those you're giving up some of those rights down the road to be able to benefit from a lower rate today, and that could be a problem when you go to leave that mortgage or to try to port it. Another thing that comes to mind is the variable rate mortgage that a lot of people have been qualifying on over the last 2 to 3 years because it was so low and
Yeah.
it was fairly easier to qualify for just because of that 5.25 rate, the qualifying rate that we had talked about. The problem with that is, to port a variable mortgage, you've got to port it dollar for dollar. Some lenders might want you to lock it into a fix before porting it. So, there's there's some limitations with products out there that for the sake of $20 or $30 a month difference in your mortgage payment, it might actually save you thousands of dollars when that time comes to move. And, the public, I don't expect the public to know that, but it's dealing with somebody who's working with a broker that's going to be able to ask those questions and try to figure out, hey, this isn't the cheapest mortgage per month. Maybe it's 20 or 30 or $50 a month more, but when you stack that up over 3 to 5 years, maybe I'm saving you 30 or $40,000 instead of
Yeah, it's
looking
the
at
back end fees basically, because some, life happens, things change, and you never know what happens in a few years, and call them the back end fees. That could be very
absolutely.
costly.
Absolutely.
Yeah,
And those back end fees, especially if we start talking about alternative mortgages or private mortgages, the market right now is hungry to get money out into the streets. And a lot of these private mortgages that may be being offered right now are significantly low sticker price, right? But then what you find out is, which doesn't always get disclosed properly, is it's so costly to get out of that mortgage on the tail end. Because at the beginning, you're not thinking about the back end, you're thinking about getting in. You're thinking about the second
yeah,
mortgage to help your family get rid of debt. You're thinking of a second mortgage on an investment property to get those renovations done so that in a year you can flip it. Well, what you don't know is those exit costs, and those exit costs could be pretty significant.
yeah, yeah. Okay, well, those are valid, great points. The last question that I have in today's call is, I mean, predictions are tough, but again, May 2023, where do you see interest rates heading? What are you advising your clients how to position themselves? I do understand every family is different, employment and investment and cash flow and all that type of stuff, but on a macro level, in the next, call it, year and a half, where do you see interest rates heading? And then, what are you advising your clients in today's market conditions, how to position themselves?
Yeah. So, full disclosure, don't listen to anything I'm about to say because I'm an idiot. So don't sue me. Don't take anything I say for being serious.
I'll put a big
Yeah,
disclaimer at the
but it's just a
bottom.
disclaimer. Here's what I think. I think that a lot smarter people than me in the world right now predict that the Fed in the United States will have to start cutting rates at the end of this year or beginning of next year. Bank of Canada might follow suit, right, as inflation continues to creep down. I don't think the drops are going to be as drastic as they were on the way up, obviously, because there was the objective there was to kill inflation by
Yeah,
increasing rates so quickly. I think if there's a lot of dialogue out there right now about a 2 or a 3 year fixed. A 2 or a 3 year fixed right now is slightly higher than what your 5 year fixed is today. But the gamble there is that you're going to be able to renew in 2 to 3 years at a significantly lower rate. I don't think we're ever going to see the 1.59%,
yeah,
1.6.
no, that was crazy. I think
Yeah,
that
I,
was
I
that
don't think
was
we're ever
part of
going
the
to see
problem.
those.
Was That's my personal opinion. Again, that was part of the problem. Just
Fuel.
ultra cheap, free
Yeah.
money.
Yeah, exactly. And I don't think we're ever going to see those days again. Will we see 3% rate territory? We might. We might. I think the biggest thing I'm advising people to do right now, whether they take a 2 year or a 3 year or a 5 year, I think my biggest advice to people watching this would be to prepay your mortgage.
Hmm.
Really, I know this is easier said than done because costs across the board are pretty high still, especially groceries if you've got a family
Yeah,
to feed. Really, really, really try to put extra money towards your mortgage. And the reason I say that is because at 5% rates, 4.5% rates that we're in right now, um, you're going to save every dollar you put in today, you're probably going to save $2 to $5 over the lifetime of your mortgage in interest. It's not, it's, the reference I always make is like in the Shawshank Redemption when Andy's got that little pickaxe and he just starts picking away at the wall. At the beginning, it seems like it's never going to work, right? At the end, he breaks out of the jail. I think that's the prepayment. The prepayment mindset is just throw those pennies into the well. Eventually, the well's going to be full of
yeah.
pennies and no water. Um, that's my biggest advice. Whether you take a 2 or a 3 or a 5 year, really, really focus on prepayments because you're going to save a boatload of interest over the lifetime of the mortgage.
What about going variable? Because again, my understanding is the penalty on a variable is 3 month interest. So, I I don't believe, I could be wrong. Again, you're the expert here. Typically, it's 5 year variable. I don't think there's a shorter term variable, but if you take a 5 year variable and you break it after 2 years, 3 years, 1 year, 4 years, it's always that 3 month interest. So it's not as astronomical as a 5 year fixed or a longer term fixed product.
Yeah. Yeah, that's a great question. On the way, hypothetically, if we are going to be starting on our way down, you are right. If
Mm.
you take a fixed, especially a long-term fixed, like a 5-year fixed today at, let's call it 4.75. If in the next 2 years your neighbor says, I just refined my mortgage and I got a 3% rate, well, it's human nature that you're going to want to do the same. The problem therein lies the penalty calculation being in a fixed rate mortgage when rates are going down. So to your point, if you can stomach taking a variable rate mortgage today at high 5% range, 5.75, right? Because it's prime plus, or sorry, prime minus. Let's assume it's prime minus 50. So today that's 6.2%. I believe anyway. I haven't done a
It
variable
is,
rate
yeah. It's
mortgage
a
in a
big,
long
okay.
time.
Yeah, I do see.
So
That's a
that
big,
up front, it's a hard pill to swallow. But what you're gambling on is you're gambling on the fact that the Bank of Canada is going to start making these decreases. The thing you got to ask yourself is that rate at, if you're currently at 6.2 with a variable, is the Bank of Canada going to lower their rate by 2% over the next 2 years? That's pretty aggressive, right?
yeah,
I
yeah,
don't know that that's going to happen, and it's a hard pill to swallow. I think personally a 2 or 3 year fixed might be the best strategy. Disclaimer, don't listen to anything I just said. Don't do what I just said. I think that might be the best strategy to wait out the market. Because the worst case scenario,
yeah,
it's the same and you just sign a renewal at the time of renewal. Best case scenario, your gamble paid off and you're able to redo your mortgage at a 3 or 4%, low 4% range in 2 years. So
yeah.
the
Okay.
variable,
No,
you are
that's a
right with
great
the
point here.
three interest. You are right with the 3 months interest, but man, it's still
Yeah,
pretty
it's
high.
it's the cost difference now into again in May 2023 that
Yeah.
it's a the delta is significant between the two products. That's great, Rob. I appreciate all your insights. Any last thoughts, comments you want to add? I know there's again lots of noise on the internet and
Yeah, there's a lot of noise.
whatever.
There's a lot of
It's
the
lots of
sky is
information.
falling.
What
I
any
I think
last
I think
words
my
of wisdom?
yeah, I think, to kind of dive into your world, the real estate world, and I don't know how you feel about this, Nawar, but Canada's bringing in a significant amount of immigration right now, where with nowhere to house them. We have a housing crisis that it seems like no level of government in this country, no matter which one you vote for, is actually taking seriously. I'm still very bullish on real estate over the next 10 years. I think that minding your debts, prepaying your mortgage, and making sure you're not making any quick shotgun approaches to buying your home, your owner occupied property. If you can if you can manage to afford a rental property, that's a whole different ball of wax, right? Because of rent increase limitations and all of that stuff that comes along with that. But I don't think the sky's falling. I don't think
Yeah.
Canadian real estate across the country is going to plummet 75% like some doomsdayers think. I mean, I just don't see that happening. I'm very bullish on, again, we've seen in May of 2023 over the last year, since February, March, April of last year, 2022, a significant decline from the highs. However, I think over the next 5 to 10 years, I'm very bullish on this country for real estate. I still am. So it's a very great investment. Mind your debts, prepay your mortgage, buy a home that you can see living in for the next 10 to 20 years.
Yeah, I mean, I echo the same thoughts. It's just it's economic supply and demand. We have huge, if you want to call it demand, with immigration and population growth. Canada grew by 1 million in 2022 per StatsCan, and we're just not building homes. So,
Matter of
sure,
fact, they're
I'm in the
burning
real estate.
down. They're burning down, like holy
Yeah.
smokes.
Yeah, so we have massive population growth. We're not building enough, and those two just it's going to put pressure. It'll continue to put pressure on house prices, condo prices, as well as rents. And I feel bad, really bad for my kids, and I don't know how they're gonna get into the real estate markets when it's their turn in a couple of years.
And just think, I'm a product of immigration. You're a product of immigration, Nawar. We're both products of a great system here in Canada that I still believe in immigration because again, I'm a product of it. And Canadian fact of the matter is Canadians are not making babies. Go make some babies. After
Yeah.
watching this interview, go make some babies. The problem is, which it seems
Now
to be
we get into real estate financing and family planning, which
that's
is great.
family planning. That's right. The real problem here is, and when people like you and I in these professions start to argue the amount of immigration that's happening, I really feel for immigrants coming to Canada today because they're really coming here to provide a better future for their kids and for themselves. And it's going to be a really, really hard go for them to do it.
Yeah,
More difficult than ever before. So
I agree,
I'm
100%.
bullish on real estate.
Before we end, Rob, where can people find you? Your online, social media, if you want to, just let us know, and I'll put it into the
Just Google.
description
That's
and
it.
comment section.
That's all you got to Google. Yeah, the Rob Campbell. That's all you got to Google. You'll find me, whether it's on Instagram or my website or Twitter. I don't know. You'll find me for sure.
Great. Well, I appreciate it. Thanks for your time, Rob, and you have a fantastic day.
Thanks, Nawar. All the best.